Hello viewers, I am Sanjeev Pandya welcoming you to the Tax Talk right here on ITV Gold. This weekly show gets you all the updates that you really need to know regarding 2021 taxes, whether personal or corporate taxes related. All the information brought to you by Sai CPA Services, a full-fledged accounting firm with multiple locations right here in the state of New Jersey. And Mr. AJ Kumar, CPA and MBA of Sai CPA Services, with over 20 years of experience, brings you wealth of knowledge, information, and guidance right here in this weekly show on ITV Gold. With that note, I'd like to welcome Mr. AJ Kumar. Sir, welcome to the show.
Thank you, Sanjeev. I appreciate that.
How's it going?
It's going great. It's going great. Being the winter season, being the tax season, no complaints. It's going great.
Working 25 hours a day. Huh?
Absolutely, that's how it is.
That's right. He's been working 25 hours a day and 8 days a week. Before we go any further, viewers, you know what I mean. That's a busy season for CPAs, but Mr. AJ Kumar takes a time out and comes here every week on ITV Gold for this tax talk show. Should you have any questions, I'll give you two options that you can reach out to Mr. AJ Kumar. One is that you can directly call his office at 908-380-6876. Visit their website, scicpaservices.com, and book an appointment however you like it. And second option is you can send us an email right here at taxtalk@itvgold.com. Listen, no question is a silly question, and there should not be any confusion about asking any question when it comes to taxes, whether personal or the corporate tax related matters. Because if you don't ask a question, and God forbid if there is something wrong on your tax return, that means you might be audited. And who gets audited? That is our topic in this week's episode. That's right, right? IRS tax audit, who gets audited?
Absolutely. That's the question we get all the time. Why me?
Exactly.
I did not do anything. Why are they auditing me? So in this episode, we want to bring a lot of information to our viewers to explain how IRS chooses the audit file, how they decide who to audit. That's the essence of the audit. The episode today.
All right, let's begin. How they decide who to audit?
Well, there are several factors. A lot of these audits, Sanjeevji, today are automatically generated. The computer decides, not the person, who to audit now.
Yes.
So the computer is deciding based on certain factors. Say, for example, the income level. One thing we noticed, people who are making less than $50,000, their probability of being audited is less than 0.5%. People who are making more than $1 million, probability of them being audited is more than 6%. So 12 times higher if your income is higher, more than $1 million in this example. So income level is deciding who to audit. I mean, look at it from IRS perspective. If somebody is making only $50,000, how much money can the IRS collect from them? If somebody is making $1 million, if you send them a letter for the audit, you can easily collect $10,000, $15,000, $20,000 from them. So the income level is deciding who to be audit. You have to look at it from the computer perspective, from the technicality perspective as well. People who are making $1 million, more than $1 million, typically they have their hands in multiple businesses. Their situation is more complex than typically somebody who has a W-2 for $50,000. So this complexity in their return is resulting into higher audit.
So higher the income, higher the chances of getting audited.
Well, that's how we see it. That's how the statistics present it. But I would say higher the complexity on your return, more K1s, more rental income, more schedules, bigger the tax return, the higher the probability for them being audited.
All right, so wherever they find the ways to take advantage of it, that's what they want to look into it, whether those advantages taken are rightfully so or not.
Absolutely. So when you have a lot of K1s, a lot of rental properties, a lot of stock transactions, cryptocurrency transaction, all these things lead to certain audit probability. So more schedules you have, potentially more chances you have for being audited.
Since you are very well experienced and knowledgeable CPA and you've been doing taxes for over 2 decades or so, my question to you is that before 2021, have you seen like a number of audited tax returns increasing every year since the last 5 years?
Well, if you leave the recent year, if you leave the 2021 and 2022 out, actually the audit probability has been going down year over year. If you look at the last 5 years, leave the last 2 years, audit probability was going down year after year, and IRS was scrutinized by Congress, by everybody, that they are not auditing enough people. In last 2 years, Sanjeevji, the problem is IRS still has more than 15 million tax returns that they have not processed from 2020. Now we are filing 2021 taxes. 2020 is not processed. So it's creating more audits, especially the computer generated audit. Let's say, for example, for any reason, you filed your 2020 taxes via paper. Now it's not processed yet. When you file your 2021 taxes electronically, the computer is seeing your 2021 taxes but not 2020 taxes. So it's creating an automatic letter coming out to the taxpayer: we are missing your tax return. You have this much income, so you owe us this much taxes. And the taxpayer feels they have already filed the taxes. So a lot of the audits in the recent past, in last 2 years, are the audits because a lot of tax returns are not processed. A lot of economic stimulus payments are not reconciled properly. A lot of audits are because of the unemployment income being not taxable. IRS changed certain rules during the year. Say if you recall, in one of the episodes we talked about unemployment income is not taxable up to $10,200. People who filed the taxes before the rule was changed, they included this income on their tax return as taxable income, and that created an automatic generated notice for the taxpayer. So leave the recent past, a lot of audits are going down. Now the audits have increased, and truth be told, IRS has assigned $70 billion to audit more high net worth clients. So the plan is IRS will invest $70 billion to hire more IRS agents, focusing on only the high net worth clients. And the plan is the ROI that IRS is expecting, they're expecting $700 billion, 10 times more money in next 10 years, just by auditing the high net worth clients. So in the near future, the audits for the high net worth clients are expected to increase even further.
That's pretty steep investment,
Absolutely.
70 billion into it and hoping to make 700 billion out of it.
Absolutely.
All right, as we go deeper into this IRS tax audit matter in this week's episode, viewers, let's find out more and more, the situation why your tax return can be audited. Income level is the one that you talked about. Second is active rental losses.
Absolutely.
How does that category work?
So let's say if you have a job and you have a rental property, then rental property is more of a passive activity. You are not going there every day. You are not spending more than certain number of hours, especially for people who have multiple jobs or multiple businesses. For them, rental property is a side business. And you have to see, most rental property results into losses only because you end up claiming large depreciation, large mortgage interest, property tax. So the rent is not sufficient to cover all the expenses when you include the depreciation. So the rental loss should be as passive loss. If you claim the rental property losses as active losses, you can offset your W2 income. IRS does not want you to be offsetting your W2 income, your active income, against the rental losses, the passive losses. So IRS goes out of their way to scrutinize that the rental losses should be claimed as passive losses, especially for people who have businesses, who have multiple jobs. Unless you have a realtor license, unless you are in this business, unless you are investing more than 750 hours on this rental activity, rental losses should be passive losses for most taxpayers.
Okay, so that's for the viewers who got properties which are on a rental, they need to know that. Now, next question I have is business meals and travel.
Absolutely.
Is that one of the areas zoomed in by IRS every year for the audit?
It is, and it used to be more scrutinized than what it is right now. See, business meals and travel is a gray area. The way the IRS always looked at, when you're taking a client out, only the client portion was tax deductible. You would have eaten anyway. So your portion is not tax deductible. That's why the IRS rule was, and we are emphasizing the word was here, that only 50% of the meal used to be deductible. Now for COVID years, for this year when we are filing 2021 taxes and for 2022 taxes that will be filing next year, for these 2 years IRS has changed the rule to fuel the economy. Now IRS is allowing 100% meal deduction. So we are not hoping a lot of scrutinization on meals and entertainment, but meals and entertainment was one area that was scrutinized all the time, if it's right or not, and if it's, who did you go out with? Was it a weekend? Did you go out with a family? Did you go to Chuck E. Cheese? How could you have a meeting in Funtime America or Chuck E. Cheese? So all those areas were highly scrutinized in prior years. In 2021 and in 2022, IRS is allowing 100% meal deduction.
Okay, interesting to know. Soon we're going to go on a break, and before the break, I just want to ask you this question, because viewers, in the second half we're going to have a lot more information regarding this IRS tax audit. Now, question to you is that what if I ignore my audit?
Well, great question. A lot of people get scared when they get the notice, Sanjeev ji. They will just get scared, and when you get scared, when you get apprehensive, a lot of time people tend to ignore these things. But ignoring is not an option in here.
Yep.
This is a government system. If you ignore your IRS audit, you will get a notice again in 30 days, 60 days. And if you don't take any action, it becomes an automatic lien against you. They have your social security number. You're talking about IRS. It's not a private lender. So the last thing you want is to ignore the IRS audit. If you're not competent, if you don't understand it, take it to an accountant, take it to your CPA, do some Google search, call us, but you cannot ignore
Never
the
ignore
IRS
it.
audit.
By ignoring it, you're not gonna get away from that issue.
Absolutely.
So might as well just make sure you take it to your accountant, or even go to the IRS office and ask them what exactly it is.
Don't ignore it. There is a phone number listed on the IRS audit. Call them. Try to understand. If you cannot find somebody, go to the CPA, go to the accountant, do some Google search, call us. Just do not ignore the notice.
All right, today we're discussing IRS tax audit. What actually triggers IRS tax audit? How does the IRS computer system picks up someone's tax return to be audited? Could be many reasons. Could be not reporting enough income, or maybe active rental losses not done correctly, or maybe business travel and meal expenses too much or not corrected. The other thing is business use of vehicle, because
Absolutely.
a lot of companies, they lease vehicles or they buy vehicles, or they inappropriately report the use of the vehicle. I'd like you to have your take on it.
Yeah, absolutely, Sanjeev. So business use of the vehicle, especially when you have one car, one vehicle, and you are trying to claim 100% vehicle deduction, IRS frowns upon it. You have been using the same car over the weekend. You have been using the same car off hours, off the office hours. So using 100% deduction is not a good idea for the business use of the vehicle. You have to see if the car is owned by the business, then only you have the right to claim the depreciation. You cannot claim the depreciation when you are leasing the car. Lease does not mean ownership. You have to have the business owning the car in order to claim the depreciation. You have the right to claim Section 179 depreciation that gives you accelerated depreciation, but the condition is the car must be owned by the business. If you own the car or if you are leasing the car, that's not an option, and never claims 100% use of the business vehicle. You always have some use in the off hours, meaning when you are not doing it for the business, on the weekend hours.
Okay, interesting. Hobby losses. If the business owner has certain hobbies, I don't know, just going to the casinos, and then taking clients with them, and if they want to report those kind of losses because related to the hobby, but at the same time they can claim as a business expense, would that work?
Well, so there are two questions in there, Sanjeev ji. Hobby losses are different than the gambling income and gambling losses. So gambling losses are allowed to the extent of gambling income, not more than that. But when it comes to hobby losses, the IRS has a different way of defining hobby. Each business has to come with an intent to make money. So if you have a business, legitimate business, in your mind it's legitimate, but you have been losing money in this business for every year, for last 5 years, then IRS says, why are you doing it? Why don't you stop this nonsense? This business is not a business, it's your hobby. You have been losing money every year for last 5 years. It's not a business, it's a hobby. You are doing it, either you are lying. If you are not lying, then why are you doing it? In that case, IRS has the right to deny the deduction for the losses you have in the business that has been showing losses consistently. So hobby losses are allowed to the extent of hobby income. If you have a business where you are losing money consistently year after year, IRS sees that you don't have an intent to make profit. If you really had an intent to make profit, either you would be making profit, or show us, do you have a website? Do you do advertisement? How do you find new customers? Show us the intent to make profit. It's not a shell company only to show the losses. That's why hobby losses are only allowed to the extent of hobby income. Otherwise, heavy losses are denied.
When the intention is not clear, or when there is an intention
Absolutely.
to either do something wrong and take advantage of it, that's when they really
A
trigger
lot
it.
of people, Sanjeevji, have a shell company. They have a W-2 job. On the side, they say, I do the consulting. In their consulting, they keep showing 10, 20,000 of losses every year to claim the tax benefit. They save a couple of $1,000s, few $1,000s every year. And after 2-3 years, IRS try to scrutinize. In this consulting business, you have never made a single penny. Where is the website? Where are the business cards? How do you advertise? How do you find customers? What did you do to find new customers? Why are you not making any? Why are you still doing this business?
These are good points. Were you ever audited tax return before you became
I have
CPA?
been part
Because looks like it, you are being devil's advocate and then trying to figure out all these questions.
Right. You're absolutely right. So a lot of people get scared when they see the IRS letter, they can't sleep. We have seen these audits day in, day out. I have been part of hundreds of such audits. So after some time, you can look at the letter and know what's happening. I mean, just recently, I finished an IRS audit, a restaurant owner who was audited for 17 and 18. In the IRS letter, he owed $280,000. After 6 months of the IRS audit, we got $12,000 of refund back to him from IRS. So IRS audit looks scary. It's not as bad. If you have somebody competent representing you and you did not lie on your return, more than likely IRS wouldn't really be penalizing you.
Good
The
to know.
intent is not to collect money from the taxpayer. The intent is to make sure that nobody is lying on their tax.
Absolutely. Do it right way. That is the intention.
Absolutely.
All right. We're down to now two most important things, and I
Please.
want everyone's attention into it. Number one is home office deduction. We know every year taxpayers really try to take advantage of it when they maintain office in their primary residence.
Absolutely. And home office deduction has become a big deduction. In recent past with COVID-19, everybody has a home office now. Even if you have a job, you have a home office. So we want our viewers to know, if you have a W-2 job, home office deduction is not allowed anymore. If you have a W-2 job, it doesn't matter how big of your home is. It doesn't matter if it's exclusive space. It doesn't matter if you have a table, bed, chair, you have a separate entrance. Home office deduction is not deductible if you have a W-2 job. Unless you have a business or a 1099, which is considered as self-employed. In that case, your home office deduction is allowed. The home office deduction you can claim in two ways. You can use a standard home office deduction, which is allowed $5 per square feet up to 300 square feet, which is $1,500. Or you can measure how big is the office space, how big is your house, then take a pro rata percentage and then try to claim the actual expense, the utility, the rent, or the mortgage, interest, whatever you have. Please remember, please understand, if you own your home and if you are claiming home office deduction or certain portion of your home, when you sell the home, that percentage, that portion becomes taxable income to you. See what happens if you have a primary home and if you sell your primary home, as long as you lived in that home for 2 years in last 5 years, the gain is not taxable to you if you are selling your primary home. But if you have been using the same home as your home office and you have been claiming the home office deduction based on certain area, then that much percent is going to be taxable income to you.
Okay, interesting. That's the home office deduction. And the last one, the important need to know, is which is cash intensive.
Absolutely.
How does that work? It's intensive, not incentive.
So what we mean by cash intensive business is a lot of businesses collects a lot of cash, say grocery store, laundromat. These type of businesses have a lot of cash coming in. So when the IRS audits these things, they are scrutinizing these type of businesses based on the zip code, based on the type of business. IRS has their own statistics to know how much cash is typically collected in these type of business. Say typical restaurant in Jersey City area or in Jackson Heights area will collect as much as 35% cash. The gross margin in such business is maximum 20%. So if you are not reporting enough cash, if you don't have all the cash reported on your tax return, a lot of times these businesses end up showing losses, and you will see a lot of these small business owners have Mercedes, large cars, big mansion, and they are showing losses on their tax return. That's when the scrutiny becomes higher. IRS has a method to measure what's your lifestyle, how much money you need to maintain that lifestyle, how much money you are showing on your tax return. Is your income is in proportion to the lifestyle that you have? If your income is much lower than the lifestyle that you are supporting, it means not enough cash is being reported. That's where the cash intensive business kicks in.
Okay, interesting. Now, based upon all these topics that you discussed related to IRS tax audit, couple of quick questions. Please. On behalf of the viewers. How far IRS goes back to the audited tax return?
Well, IRS has the right to go back as many years as they want if there is a material misstatement. Otherwise, the rule is 6 years, but most audits are limited to 3 years. After 3 years, IRS typically wouldn't go out of their way to audit anything. The IRS rule suggests that you have to maintain your records for 6 years. IRS has the right to go back as many years as they choose to if they find more than 50% of your income was not reported, or if you completely forgot to report a W-2. If there's a material misstatement, they can go back as many years as they choose to.
Okay, next question. If someone receives 1099K, do IRS audit has a certain kind of system to go after those 1099K specifically?
Absolutely, it's a new requirement. I'm glad you mentioned it, Sanjeevji. So 1099Ks are now reported to IRS as well. It's a new development, just started a couple of years ago. Let's say a 1099K is generated based on the credit card processing. Let's say your business collects money through the credit card, and your business collected $1 million through the credit card processing. And this shows up on the 1099K. Now the IRS knows that your business collected more than $1 million. If on your tax return you are showing total revenue of $700,000, this is not matching, this is not right, because we know, IRS knows that you collected $1 million just through credit card only. So how could your revenue be less than that amount? So the essence is your business revenue, and we are talking about the gross revenue, the total revenue must be higher than the amount that's reported on 1099K.
Very obvious, very good. Okay, as you mentioned in the first half of the show that when you receive an IRS tax audit, you don't need to be scared. You should just give them a call or go to your account or whatever the options are. What if someone misses, IRS audit letter in the mail? What if they miss it? And even if they get it a little bit later on, can they request IRS to remove penalty?
It depends on situation to situation. In recent past with the COVID-19 and mailing delays, it's more common than what it used to be. Now there are a lot of people who misses the notices, the letter. Whenever you find out about this audit, you call them, explain your situation politely to them. Even if they don't remove the penalty immediately, the least they will do is to give you additional time. They will give you additional 30 days, 60 days, and they will allow you to justify your case. If you have a justification to remove the taxes, they'll be happy to remove the penalties. In most cases, the penalty is a factor of the actual tax liability. If you owe $10, the penalty is typically $2. If you don't owe the $10, they will remove the penalty automatically. But
they will work with you. Basically, they will work with
you.
They
will definitely
once they find out the intention is very honest of the taxpayer, then they will definitely work with you.
Absolutely. That's
all right. Now, in this summary, you've got 1 minute, whatever that you want to cover regarding this IRS tax audit, or if we missed anything, go for it.
Well, we want our viewers to know that IRS audit is a fact of life. A lot of people are being audited. Millions of taxpayers gets audited every day. If you get an IRS notice, absolutely nothing to be scared about. You look at the notice, there is a notice number, there is a phone number over there. You put that notice number on Google, try to understand what happened. Try to open up your tax return. Go to the person who filed your tax return. Call the IRS phone number to understand what happened. Please do not panic, do not be afraid, and do not ignore it. There is a good reason. You probably missed a small thing. A lot of audits happen because people miss the interest income, $10, $20, and now they have an IRS notice. So it's not about money. You do not want to ignore it, and whatever needs to be done. If you missed something, let's fix it. If you owe something, let's pay it. Nothing to be scared about. But you do not want to ignore this notice. Please call the accountant. Please go to the IRS website, call the IRS, and make sure you take care of it.
Okay, very well. Thank you so very much. And even after all that things, if you're still confused, remember, Sai CPA Services is your point of contact. They can really help you to solve not only tax-related problem, not only your accounting matters, but they can also help you with starting up a business, setting up a business entity, and guide you what kind of entity. You should have full-fledged accounting firm with multiple locations in the state of New Jersey. Sai CPA Services, for all your tax matters, personal or corporate. We thank Mr. AJ Kumar of Science CPA Services for joining us every week right here in this show, the Tax Talk on ITV Gold. I am Sanjeev Pandya, wishing you all happy and tax-free days ahead. So long.